It's 4 p.m. fill time. After a cheeky break, we're back and ready to give you your fill of the market this week. We're at Savannah HQ's bullpen, and I'm with Savannah Associate Director and our resident equities expert, Sam Atkinson, beside me as ever.
Thanks, Jack. It's a pleasure to be here as always.
Indeed. And it has been a lot recently, to say the least. So break it down for those of us that are confused by the market turbulence.
Well, Jack, it's great to be back in the studio with you because it's been a crazy few weeks on the market and there is a lot to discuss. To start, let's have a look at where we are year to date. As you can see, our local ASX is down 2.89% for the year. That's actually holding up pretty well compared to the US, with S&P 500 and Nasdaq down 3.5% and 6% respectively. Remarkably, Jack, the Euro Stoxx 50 continues to buck the trend. It's up 12.7% for the year. The UK's FTSE 100 not doing so badly either, up 6.5% for the year.
Thanks, Sam. And what can you tell us about this week's trading?
Well, markets have actually rallied a little this week, as investors are beginning to hunt for bargains after some heavy losses in the last few weeks. Investors were also buoyed by higher than expected retail sales in the US last month, rising 0.2% after declining 1.2% in January. But the big news for the week, Jack, was of course the US Federal Reserve's decision to leave interest rates on hold. This was generally well received by the market, with Jerome Powell indicating that 2 rate cuts were expected by October this year. Similarly, in the UK, the Bank of England has also left rates on hold for now. Just quickly, Jack, they're in a really tough situation. GDP growth in Q4 last year was just 0.1%. Meanwhile, the inflation rate has been trending up again, currently at 3%. Many economists think that this could get to 4% very soon due to increases in the minimum wage and higher payroll taxes. So Jack, they're faced with the daunting challenge of lifting growth while capping inflation. Not an easy thing to do when productivity growth in the country has been negative over the past 18 months.
Good luck, Keir Starmer.
But Jack, I'll leave it there for this week's update. Let's get to your hot take.
Euro trash is this week's theme. Let's take a look at the continent's bleak numbers. Growth. The Eurozone barely escaped recession, posting 0% growth in Q4 2024. Germany shrinking. France stagnating. Italy on a long road to recovery, trying not to collapse. Industrial production is down 6% year over year in Germany, Europe's shining light. So much for the world's manufacturing powerhouse. Their economy shrank last year. The country that once built the Autobahn now has an economy stuck in first gear. Unemployment. Youth unemployment is over 27% in Spain, 22% in Italy. Basically, Gen Z is on a government subsidised siesta. That's a tongue twister. Demographics. Europe's working age population is expected to shrink by 50 million by 2050, meaning fewer taxpayers and more retirees cashing in. By 2050, 1 in 3 Europeans will be over 65. That is a lot of pension payments, and that is not enough workers. Now there's a China dependency as well. The EU imports 90% of its solar panels, 80% of its lithium, and 60% of its electronics from China. That's like giving Beijing the keys to your economic engine. And let's not forget the energy crisis. After cutting off Russian gas, Europe is now dependent on imported American LNG. As if he needed more, that's plenty of leverage for Trump, who doesn't need much ammunition to take away their treats and teach these spoiled dependents another lesson. Europe is so focused on being wokey progressive that it's forgotten how to be productive. While the rest of the world is racing to out-innovate and outgrow each other, Brussels is busy regulating lawnmower noise and debating whether 4-day work weeks should come with mandatory nap breaks. Meanwhile, loose mass migration policies and endless identity politics grandstanding is causing mayhem, preventing real progress, and dividing already suffering societies. But hey, at least corporate boardrooms are inclusive and diverse while the economy flatlines. The continent is becoming an economic museum. Beautiful to visit, but not where you'd want to invest. And so there you have it. Eurotrash is this week's hot take. And now it's time for the punter's real favourite. It's the Sam's Market Insight segment.
In light of US markets plummeting 8% over the past few weeks, a lot of people are asking the question, do I buy the dip or sit on the sidelines? Let's be very clear, Jack. No one can predict the future, and what happens in the next couple of months in the market is literally anyone's guess. But if you zoom out and look at the market return over the past 80 years, performance has been remarkably consistent. Here is a chart showing the log inflation-adjusted return of the S&P 500 over time, along with applicable trend lines across all time, 50-year, 25-year, and 10-year time horizons. You can see that these trend lines are so consistent that they are almost indistinguishable from each other. So, if you're like me and believe that population growth, human ingenuity, innovation, technology will continue to drive market growth long into the future, then you might also believe that the long-term trend of market returns can actually be a powerful determinant of current market value. The reason this is relevant, if you look at the inflation-adjusted S&P 500 chart, you can see that despite recent falls, its price is still trading materially above its trend. Indeed, a further fall of around 8% would be required to drag performance back to the long-term mean. Conversely, if you look at the equivalent chart for the S&P 600 small caps index, you can see that price is actually trading around 10% lower than its historical average. So Jack, while not a panacea, this provides further evidence to my thesis that small cap companies are structurally undervalued and represent a superior buying opportunity in this environment. That's why at Savannah Asset Management, we are focusing on the small cap space, particularly in the US market.
As per usual, ladies and gentlemen, we've delivered a masterclass. So, subscribe to the show wherever you're tuning in, and I guess we'll see you next week.
Cheers. What am I?
Good stuff, brother. Excellent. No bruising, brother.
No, shame.